What does retirement at age 60 look like for Allison in Northern Virginia? The EasyRetirement.com calculator says Jimmy and Rosalynn in Georgia are on track to reach their retirement goals, even though they're late starters. But are they being realistic? Ingrid used the free EasyRetirement.com calculator too, but is she able to contribute more than her annual income to her 403b and her Roth? That's today on Your Money, Your Wealth podcast number 467. Plus, Perry and his wife in Winston-Salem also have 403b plans, and they wonder if they should take the lifetime annuity or the managed payout in retirement. Finally, should Brad in Sarasota, Florida reserve his health savings account money for long-term care insurance? I'm producer Andy Last, and here are the hosts of Your Money, Your Wealth, Joe Anderson, CFP, and Big Al Clopine, CPA.
We got, hey guys, and Andy. This is Allison from Northern Virginia. In my last question, well, you know what we got to do, Andy, here?
Uh-oh.
We got to sort this stuff out. We got double dippers and triple dippers here. Sure. And we got first-time callers
and we got 45 pages.
We're just kind of pushing them out. So, hey, we love the multiple questions. Some of you are taking advantage. There's like, hey,
and here's
here's
page,
another rebuttal.
Full page question.
From my 15 questions that I've asked over the last 15 days. And here's my portfolio. Can you please take a look for me?
Right.
So in other words, you want to prioritize people who've never written in before?
Yes, I think that's the right thing to do.
I think that's fair.
No offense.
Which means that all of our core listeners are going to completely make up their names from now on.
That's all right.
First time listener.
Well, I'll tell you what, we'll still answer them, but it might be on an email. How about that?
Yeah.
We'll get to them. Allison, now back to Allison.
Okay.
In my last question, I asked if I should do a Roth conversion with my rollover IRA because I would have over $45,000 in a charitable donation in 2023 due to a situation with an inheritance. You said I should. Wait a minute. We were just talking. We're not giving advice on this show, folks. We might have been just having a conversation. She's like accusing. You said we should. Something probably blew up here with Allison from Virginia.
Here's what
wait for it.
Here's what we probably said. We probably said, yeah, I would probably do that, or I might do that.
I don't know.
Yeah, probably would.
If it was me, I'm not saying Allison do this. We're not saying
you didn't say that.
No, we did not
Allison,
say this.
Here's your advice. No, we didn't say that.
So I'm just waiting for the shoe to drop here.
Okay, here we go.
You said I should.
Okay.
I executed that rollover in late spring of this year. I'm estimating that I will owe between $1,000 and $2,000 in federal taxes in April due to the rollover and some RMDs I had to take due to my inheritance.
Okay.
My family member's estate is almost done. I should get about $4,000 more from the estate, which I will likely put in my brokerage account. With my inheritance and what I will continue to save through 2029, I think I can retire in June of 2028. Would you do a retirement spitball for me? No. You're done. Move on. Next question. Who do we got? We got Claire from Colorado. No, I'm kidding.
Wow, that's getting pretty hardcore.
Okay, let's see what her stats are. A little 55-year-old single female with no kids, federal government worker. I want to retire in June 2028, 60. I receive $3,000 a month in pension gross with small COLAs. I will have a monthly supplement of $1,100 a month from FERS until I'm 62. I will keep my federal subsidized health insurance. My Social Security will be about $3,000 at full retirement, 67, or $4,000 at age 70. Keep it score here, Al?
Got it. Yep.
All right, hold on. Excuse me. I want to spend approximately $7,000 to $7,500 in today's dollars at retirement. How much does she have in fixed income with just the numbers I read off? Close to that, right?
If she's got 3,000 pension plus Social Security, so yeah, pretty close.
6 and then plus some FERS to 62. And
yeah.
All right. Home is now paid off, but I may move in retirement and may need to take on a mortgage of about $200,000 to get the property I want. I'm currently maxing out my TSP and catch-up contributions. Contributions are about 1/2 traditional, 1/2 Roth. I did not do any Roth IRA contributions in 2023 as my income with the IRA rollover in RMDs was too high. IRA rollover, why would that, or is she talking about the conversion?
I think so.
A Roth conversion does not impact your ability to do a Roth contribution. So
True.
Just-
A lot of people don't know that, though.
Just FYI. Well,
It-
that's why we're here.
Yeah, because it's a modified adjusted gross income for a Roth contribution.
So I think you're still good, Allison, if you
Yep.
want to do a Roth contribution.
Yep.
Just take out that conversion and look at your adjusted gross income. Okay. Where am I at with this? Decided not to do a backdoor contribution. So she's decided not to do anything.
Yeah, I didn't want to.
Yeah. Just like, but I told her to. Let's do that conversion.
You said it.
You said so. Not sure what I'll do for 2024. No, Dad, I'll take home approximately $6,000 a month right now after deductions. Asset total 1.1 million. What does retirement at 60 look for me? Since my last question, I purchased a new silver Toyota Camry hybrid, which I love. Did I tell you to do that too?
You said she could afford it.
Yeah,
And
go
you,
ahead.
and you said get the silver one,
Yeah,
not the white
silver
one.
Yeah. Well, I listened to the
And go
podcast.
hybrid.
I listen to the podcast on Tuesdays during my commute or on a walk around my office area since my agency has given us a few wellness hours each pay period to exercise. Well, wellness.
And learning at the same time.
Wow. My drink of choice is still a little Diet Coke and a hard cider if I have an adult beverage.
Okay.
Thanks for the podcast and the spitball information you could give.
See, she didn't accuse you of anything. She
Yeah.
just thinks that you give like the best advice.
Yes, I don't give advice. We don't.
I
give-
know.
we're just shooting
Shooting the breeze.
shooting the stuff. Yeah, yeah. You're fine, Allison. You go. Well, hold on.
Yeah. She's fine.
Well,
Yeah,
this is not advice, Allison.
Okay, I think she's fine. How about that?
1.1 million. Your pensions are going to cover most of the fixed income that you have. You can have another $3,000 in some change from your portfolio, maybe even $4,000 additional. Now you're looking at $12,000 a month. You want to live off 7. That's going to cover your taxes. Yeah, and your other little Toyota Camry hybrid in another 5 years that you want to buy.
Could do that.
So
Yeah. So I actually did a little bit more analysis. So she's got 1.1 million.
Yep.
Wants to retire in about 5 years.
Yep.
I'm just assuming she's adding about 30,000 a year. Future will be about 1.6 million
Mhm.
when she retires. Her expenses at that time for inflation will be about 104. So 104 minus Social Security of 36, that leaves 68. Not social. I'm sorry, pension.
Yep.
Without Social Security leaves 68. Divided into 1.6 million is 4.3% as a 60-year-old. Might be a little high. If you didn't have Social Security, because you have Social Security, I'm fine with this.
Yeah, I think you're right there. Unless the market totally blows up in the next 5 years.
Well, then you go back to work.
And your 1.5 is now 900. But here again is my point. So with these spitballs that we're doing, this is a tenth of what people really need to be thinking about, right? So
Sure.
we're just seeing, all right, it's a real simple question is, hey, can you spitball this for me? Am I on track? Yes, you're on track, but there's multiple strategies that people should still look at.
Right.
You know, from a Social Security claiming strategy. When should she take it? 62, 67, 70?
Yeah.
She's got this little bridge with FERS that will take her to 62, but realize there's pros and cons of taking, Social Security early. A lot of people love to take it early. We say take it early, right? Because then, A, you have more fixed income. That's less demand from the portfolio.
Sure.
I love to party in my 60s and I'm not going to party in my 70s.
Yep.
All right. Well, then take it at 60. But if she takes it at 70, her distribution rate is going to be 6% for maybe 10 years.
Right.
And if the market is volatile, that could definitely blow up her overall retirement strategy.
Yeah.
So there's so many other things that people need to still consider, because I know we're going to get an email one of these days.
You said.
You said,
So
and now I'm broke.
so probably a better way to say this is you're in the ballpark,
Okay.
right?
Yeah.
So there we go.
Okay. Thanks, Allison.
With the money that you have saved right now, will you be able to retire at age 60 like Allison? Maybe 65 or 70 or never? What if the market does blow up? Doctors Joe and Big Al are in the house on Your Money, Your Wealth TV with your retirement rescue plan. Watch it in the podcast show notes and make sure you download the free companion retirement rescue guide. It's only available for a limited time, so download it before this Friday. Revive your retirement and go from just barely surviving to thriving. Click the link in the description of today's episode in your favorite podcast app to go to the show notes. You'll see the TV show, the guide, and other free financial resources right before the episode transcript.
Hey, Andy, Big Al, Joe, love the show. I've been listening for a few years. Typically listen while on the treadmill or doing my commute to work.
Okay.
All right. I'm writing to hopefully balance the normalcy of your content. All right. I am not 35 years old with $6 million in the bank, planning to work for another 20 years and wondering if I'll be okay.
Yeah, we do get that sometimes.
Yeah. They usually start out, I have 8 mil. Oh,
Should I put money in a Roth IRA?
yeah. I drive a Mazda CX-5. My husband drives an RDX. All right. We have 2 bogey pups.
Bougie, as in bourgeois.
Bourgeois.
I would have said boogie.
Boogie.
So
My hubby doesn't drink, but I enjoy a glass of wine, a Corona Light, and an IPA all at the same time. No, I'm kidding. She would say that. But she only does that once or twice a week.
yeah, okay.
We got started a little late with being intentional. Is that right?
Yeah.
Intentional about retirement.
Yeah.
I'm 51, husband's 60. We'd like to retire when I'm 58.
Okay.
From my calculations, including what I've come up with using your easy online tool, I think we're okay. But I'd love to hear your spitball on whether our assumptions and goals are accurate and realistic. All right. So she's using a little easy retirement tool.
Yeah. How do we access that?
Go to easy retirement. That's all you got to do.
And it's spelled EASI, retirement.com.
It's not that easy. It's not.
EASI retirement.com.
Yeah.
Okay.
You know what that stands for?
No.
Education, assessment, strategy, implementation.
Of course, it always sounds for something cool.
That's Mike Fennison right there.
Hours and hours.
2 months, no, years and years. Love you, Mike, if you're listening. Retirement. Got $700,000. Other assets, $250,000. They got $170,000 on a house with a $450,000 value, tax value, but a $600,000 market value. Okay.
Okay.
They make $280,000 combined. They save $50,000 a year in the 401k, and they do a little Megatron Roth. Oh,
okay.
I spend the last few years. Oh, our spend the last few years range from 90 to 110, and I don't see that changing.
Okay, good for you.
All right.
Spending less than you're making. That's a recipe for success.
Yes. Social Security. We plan to start my husband's when I retire and he's 67. I'm hopeful. I'm hopefully put mine off until 70, and it is currently estimated to be $3,300 a month if I stop working at age 58. We are working toward and on track to have $500,000 in that other category, see above, as a bridge account for expenses when I stop working to delay pulling from our retirement accounts. We also plan to double down on converting my husband's IRA to a Roth when we don't have income to battle future RMDs. We started that a couple of years ago, but then paused because of taxes. We are dinks.
Double income, no kids.
Got it. So we're not trying to just live off of the interest in retirement. We're fine if we need to pull from the principal. Thanks for the spitball. And the good and entertaining work all around. Jimmy and Rosalynn from Georgia. All right.
Okay.
They got how many years? 7 years to go?
7 years to go.
Saving $50,000 a year?
Yeah, I'm getting at 6%, 7 years, starting with $1 million. They probably will have about 2 million, 2.1, something like that.
Yep. 10, let's say 3. So that's 60,000.
Yeah, and let's say spending by that time with 3% inflation would be about 136 minus Social Security shortfall is 101. We divide that into 2.1. We get about a 4.8% distribution rate. So that's
It's a little rich.
It's a little rich. It's close.
She wants to push hers off till 70, so that burn rate's going to be a little bit higher.
It's a little bit higher. That's like 12 years of a high burn rate. Yeah, that's that's a little shy, I would say.
Yeah. 58. Well, her husband's going to be able to claim, and what's his social $2,200?
Yeah, so that's 26,000. I factored that in.
Okay, 26, 2 million, call it She's 58. Probably don't
Yeah.
want to pull out more than 3% from the portfolio. So
Well,
that's 60,000.
You might be able to pull out 3.5 or even close to 4 just because her Social Security is
will
coming.
kick in. Sure.
Right. I guess that's what easy retirement said.
Yeah.
But it's a little bit tight for my liking.
Yeah, me too. Yeah. It all really depends on the assumptions of what the overall portfolio is going to do.
True.
You know what I mean?
True.
It's going to make or break it. If the market does pretty well over the next 7 years, then okay, well now it's not 2 million. It could be 2.5 million with the amount of money that she's saving. If the market's flat or goes down, I mean, it could be 900,000 and she's working another 5 or 6 years.
Yeah, yeah. But I did with 110,000 spending. What if it's 90? Maybe this looks fine. So if you think about it that way, if you don't want to work part-time, then you make some sacrifices. You have a spouse that's older, right? So you'd like to spend time with your spouse. So I could see it working, but maybe spending closer to the 90,000 than the 110.
All right. Very good. Thanks for the email. Got Ingrid. Ingrid writes in. Hey, I'm getting my easyretirement.com data entered. Ever heard of that Easy Retirement?
Yeah, we just talked about it.
Just throwing out
EASIretirement.com. Is that our website or
I don't know.
Where do they find it, Eddie?
Hey, go to easyretirement.com. Yes.
That's easy enough. Okay.
Yep.
Very easy. Everything's easy here. I'm 69, single, 3 children, not collecting Social Security until 70, and trying to do last-minute tweaks and rollovers. Salary is very low now. Working part-time, $50,000 a year. Still contributing $30,000 to the 403B this year, mainly for tax reasons, so that I have less tax consequences when I sell some of my appreciated but risky stock later this year.
Okay, cool.
Income may end earlier in the year versus end of 2024. I can't predict it. Say I contribute $30,000 to my 403B and get that in there. Do I have to earn gross $30,000 plus an additional $7,500 in actual salary wages in order to contribute $7,500 to a Roth? Or can I double tap my total wages to count towards both contributions to the 403B and the Roth, which essentially ends up being more than my actual wages in 2024? For example, if I make $32,000 this year, can I still contribute $30,000 to my 403B and $7,500 to a Roth? Because technically, I've earned enough to contribute to the Roth, even though most of the salary is going to the 403B. I can't seem to find the answer anywhere. Maybe it's an unusual question. I have 2 more years to either sell the stock. It's appreciated at 1,100%.
It's a big number.
It's a pretty good.
Is that? I think that's 12 times.
It's a little 12 bagger.
I think that's how you do that because 100% is double.
Yeah.
So 200% is triple. So I think that's 12 times.
Good for her.
12 bagger.
Yeah, 12 bagger. Just put 12 of those in the bag and shake it up. Get 12.
Right.
Or to do a Roth conversion, and I think I have to run out of time to do is in any reasonable way as the amounts are too large. Right. Okay, so she's got a couple years to sell the stock.
Yep.
We don't know how much the stock is worth, but it's up a 12 bagger. She just likes to talk about, hey, I got $40,000 in it, but I was up 11,000% because I started with 5 cents.
Just go 12 bagger. It's easier to say and conceptualize.
Okay, so she wants it, or should I do a Roth conversion? I think I've run out of time to do this in any reasonable way as the amounts are too large. Sure wish I knew about all this 10 years prior to retirement versus 2. I hope not to take the RMDs until 73, 2027, and I will be forced to officially retire at the end of 2024 or earlier. Thank you for guidance you can offer. You have a very excellent show and information. And is also organized and well done, that it inspires quite a lot of trust and admiration.
Dang.
Wow.
What the?
That's
Thanks, Ingrid. That's awesome.
Oh my goodness. It's the nicest compliment I think we've ever received on this show.
Pretty
so.
sweet.
A lot of trust and admiration.
Yeah. Can't get
Well,
much better than that.
we do say we're trustworthy by design.
The show is designed by Andy. She's so trustworthy. I don't know what.
Well, for the first question, I can answer that. So no, you can't double dip on that. So here's how this works: is you've got a salary. Let's just say your salary, use your example of 32,000 and 30,000 went to the 403B. So that's a deduction, right? So that comes off of your salary. So your W-2 is going to show $2,000. So you can do a $2,000 Roth IRA.
Easy enough.
Easy enough on that one.
So congrats on the triple bagger. And good luck on selling that.
Yeah, and as far as selling the stock, I mean, ideally you do it before your RMDs, although you haven't told us how much you have in there, so I don't really know what those are.
Yeah, I don't know what the value is of anything. So she's all right. Do I sell some of the stock that's up 1,200% over the next couple of years while I'm in a low tax bracket to take advantage of the 0% capital gains rate? Maybe is that what she's asking? Or do I do a Roth conversion because I don't want to have a huge RMD? So dollar figures would
be super helpful. I mean, just without dollar figures, I would say if you have
he's got to get out of the stock that's up 12,000%.
Right. If you have a highly appreciated stock that's a meaningful part of your portfolio, that's too risky. So start selling it. Do Roth conversions later.
Tax, you're up 12,000%.
Well, 1,100%, but 12 bagger.
You hit the lotto.
But yeah, diversify. That's going to be more important than the Roth conversions. You can do your Roth conversions later. Even when you start taking RMDs, you can still do Roth conversions as long as it makes sense in your tax brackets.
All right. Congrats.
Jimmy and Rosalynn and Ingrid have all done their own spitballing at easyretirement.com. Now it's your turn. Go to easiretirement.com, create a login, then enter your income, savings, and expenses. If you take the quick path, you'll know in about 2 minutes whether you're on the road to retirement wellness or disaster. The easyretirement.com calculator is constantly improving. Not only can you change your own numbers to see how it impacts your future retirement, you can also switch between optimistic, average, or pessimistic assumptions for inflation and returns. And you can test different budgeting scenarios and withdrawal strategies. And even if the easyretirement.com calculator says your chance of success is high, schedule a one-on-one with an experienced human financial professional from right within the calculator and get help creating even more sophisticated financial strategies to meet your retirement needs. Start calculating your retirement wellness now for free at easyretirement.com. That's EASI retirement.com.
Answering your money questions. Go to yourmoneywealth.com. Click on that icon. How many people actually click that stupid button? Not many.
A bunch.
Do they just go to info, or do they go to Big Al Ask Now?
Actually, most people now are clicking on Ask Joe and Big Al. We've got, what is it, like 45 pages worth of questions now. We're just getting into the middle of November. So if you send us an email in November, we might get to it here shortly. So yeah, the majority of them are Ask Joe now.
All right. We got Perry. It's been sitting on the sidelines here from Winston-Salem, North Carolina. Is that where something happened in Winston-Salem?
No, that's.
Are you thinking of the Salem witch trials?
Yeah. Right?
No, that was Massachusetts.
Yeah.
I got it. Winston-Salem. Is this
Salem.
where like Winston cigarettes came from?
Probably. That'd be more likely.
Got it. Hello from North Carolina. My wife and I are retired, age 68 and 67. She drives a Lexus ES, and I drive a little Lexus RX. So Lexus family here, Big Al.
Yeah, I see.
I like iced tea, Duke basketball, in a day on the golf course.
Awesome.
I wonder what his handicap is. I guess it doesn't really matter. You enjoy the game. I enjoy it.
It really doesn't matter, right? Just if you have fun, right?
I guess so. Here are the facts. We have about $855,000 in a rollover IRA, $650 in a Roth IRA, $750 in a brokerage account. We get around $55,000 in pensions and Social Security annually. Our expenses are about $100,000. No debt. We have $550,000 in our house, and we also have long-term care insurance. Okay, we've been retired for 6 years and have completed our Roth conversions. So you complete a Roth. Yeah, I mean, you set it and now it's done. You check the box.
Sure. Yep.
In addition, we also have some 403B accounts with the same employer. Mine is around $500,000. My wife's $400,000.
Yeah.
We have not taken any distributions yet, but before age 73, we will have to convert each account to a lifetime annuity or a computerized managed payout plan. Interesting.
Yep.
The decision on each account is irrevocable. The company is so large, it has its own pension and benefits agency, its own proprietary stock and bond funds, as well as its own annuity pool. The annuity they offer is 0, 2, 3, 4, or 5% COLA choices, as well as a joint 70, 85, and 100% survivor options. With their managed payout offering, each account would continue to be invested with monthly distributions programmed to last a lifetime, with no guarantees. Distributions would be adjusted every year based on market conditions, inflation, and rebalancing. No personal account withdrawal would be allowed, but any balance at death could be left to the survivor or an heir. So with our $900,000, my wife and I could choose 2 annuities or 2 managed payouts or one of each. I wish we could manage these accounts and distribute them on our own, but it's not permitted. We have some time between now and age 73, but any thoughts you have on a decision would be greatly appreciated.
Okay, so we got a company pension plan. You pick a lifetime annuity or a managed payout. Lifetime annuity meaning that you get a payment plan for life, but then it stops.
It's guaranteed for life
when you pass away. But there's a survivor option. So, but when you both pass away, it's gone, right? Managed payout plan is, what's that?
Well, if they were to pass, it would still go to the heirs.
Yeah.
So it's not
whatever's
they're not annuitizing.
Right.
They're taking a look and saying, all right, well, here's the overall payout. It's still managed. So it could run out of money too. So the payments aren't guaranteed.
Right.
But basically they're keeping the monies in the plan and they're going to calculate a payment from the overall plan each year based on inflation and so on.
So I would imagine the lifetime annuities probably a higher payment than the managed payout plan.
I think so.
Would that be your guess?
That would be my guess.
Yeah.
I don't know. I want to see some numbers.
Yeah, we wouldn't know how to answer this.
There's no way.
Yeah.
Do one of each. That's an easy way out. I like the managed plan, but it seems to me he's got already $55,000. He needs $45,000 from the overall portfolio, and he has $2 million roughly of liquid assets.
Yeah,
not including this $900,000.
Yeah, so it's a 2% distribution rate just right there.
Right. He's not going to need any of these other liquid assets.
I agree with that.
This managed payment or the annuity is probably going to give him his living expenses.
Right.
And so any added is going to come from his liquid portfolio. And so I would look at, well, what he feels more comfortable with, but just understand that if you annuitize, you get a little bit of a COLA. If you get the managed payout, you're probably going to have more of an accelerated annuity payment depending on how the market does.
Right.
The market trends up, the payments are going to continue to rise on them.
So yeah, so we don't have near enough to answer this question, but just based upon what we know, I'm going to say I would be more likely to favor the managed payout plan only because I'm set otherwise with all my other assets.
Yeah, that's what I was thinking too.
Yeah. But when you look at the numbers,
I would need to look at the plan.
Yeah.
I would need to look at the plan.
Right.
It's like, what do you think? Well, I have no idea what the annuity payment's going to be. Got an internal rate of return that you're going to receive.
Now, if the lifetime annuity payment is way higher, I might, okay.
Right, because
I'm healthy.
It seems like they have their own benefits and they're running their own the company's huge.
Yeah, right.
So they're like, all right, well, we're going to annuitize this and pool the risk. So it could be a lot higher payment than maybe another standard annuity, commercial annuity. I don't know.
Somewhat dependent upon your feeling about life expectancy.
Yeah. Sorry, Perry. Enjoy your time at the golf course. Hello again, longtime listener, second time
poster.
Oh, poster. Yeah, I haven't said poser at first. My wife and I are still driving that 2019 Ford Fusion Hybrid, and I still like my martinis very dry and stirred. Never, ever shaken. This is buddy Brad from Sarasota, Florida. I'm 64, and my wife, she's 65. We have $1.6 million in traditional IRAs, $400,000 in the Roth IRA, $750,000 in savings and brokerage accounts, $100,000 in HSA. My question concerns is on an HSA strategy, health savings account, for those of you that are keeping score here. And I'm hoping you could kick around for me. My wife and I are in good health, but we are concerned about the impact of long-term care expenses in the future. My goal is not to touch the HSA, but instead let it continue to grow as a reserve to help cover long-term care expenses should either my wife or I need it. In the meantime, I'm saving all of our medical receipts. I understand that these medical receipts can be used to pull the money out of the HSA tax-free, and there's no time limit when I can use them. If we don't end up using the HSA money for long-term care, we could still get money out of the HSA tax-free using our banked medical receipts.
Okay,
It's banking them.
Quite a strategy. Let's see, 50 years ago, 40 years ago, 30 years ago.
I had a root canal. Here's here's the receipt.
And I paid cash. I think I paid about $1,800. Here you go.
Oh my God. Does it make sense to reserve HSA money for long-term care? Our goal is to spend down the entire HSA tax-free in our lifetimes. Thanks for spitballing this one for me.
Okay.
Brad. Wow. Just clipping coupon for the HSA.
Well,
bought some toothpaste. I got an ace bandage.
I got a toothpick.
I sprained my ankle when I was 16.
I don't think my parents paid. I gotta pay now.
All right. So, okay, long-term care. Saving this $100,000 for a long-term care stay.
Yeah. So, well, first of all, a couple things. So HSA, you put the money in, you get a tax deduction, you pull the money out for medical purposes, and then it's tax-free. So you get a tax deduction, it grows tax-free, you never pay tax on it. So that's a great deal, right? Do you want to use it for long-term care? No, not really. Because long-term care is usually deductible.
It's super expensive because you can write it off on your Schedule A.
Yeah, that's right. So I wouldn't do it for that. And the other thing too is if you keep banking all these expenses and you pass away, you both pass away, it goes to your kids and they got to pay taxes on this. So make sure if you want to bank them, I'm okay with that. But get those in before you pass. Don't be together in a car.
Yeah. When it comes to long-term care, sometimes a retirement account might be a better use because let's say you have to take $100,000 of an IRA. Well, it's all taxable, but then it's going to be over the threshold for your health expenses on your tax return. So a lot of that could be deductible.
Yeah, and see, that's the thing. A lot of people don't realize you go to long-term care stay, generally most or all is tax deductible as a medical deduction. So you're not going to pay tax on the IRA income anyway.
All right, Brad, keep banking. keep saving those.
But get that money paid back, and so you don't lose out on this.
Yeah, love it. That's it. I'm done. See you next time. Show's called Your Money Well.
Joe's playing Hurt again. Joe versus Martinis, Bougie Dogs, and a new song about the podcast in the derails at the end of the episode, so stick around. This is Your Money, Your Wealth, Your Podcast. If you enjoy YMYW, tell your friends, your family, co-workers, neighbors, the mailman, and that cute barista down the street about it, and help us reach more listeners like you. And don't forget to leave your honest reviews and ratings for Your Money, Your Wealth in Apple Podcasts and all the other apps that let you do that, like Amazon, Audible, CastBox, Good Pods, Pandora, Player FM, Pocket Casts, Podcast Addict, Podchaser, Podknife, and Spotify. We're on all of them. Your Money, Your Wealth is presented by Pure Financial Advisors. To really learn how to make the most of your money and your wealth in retirement, you need more than a spitball. Schedule a no-cost, no-obligation, comprehensive financial assessment with the experienced professionals on Joe and Big Al's team at Pure. Click the free financial assessment banner in the podcast show notes at yourmoneyyourwealth.com or call 888-994-6257 to book yours. Meet in person at any of our locations around the country or online right from your couch. No matter where you are, the Pure team will work with you to create a detailed plan tailored to meet your needs and goals in retirement. Pure Financial Advisors is a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full and informed investment decision.
Yeah, as you choke on your...
Yeah, I'm playing Hurt today.
Well, you got little kids.
I know.
You get sick all the time.
I do not. And everyone at my house gets sick, and it's like I'm the guy that just keeps plugging. But I did catch like I don't know. Sometimes I've been talking all day too.
I know.
So
okay. You like martinis dry, or I should say stirred or shaken?
It's been a while since I've had a martini, Big Al.
I honestly may have never had a martini in my life, so I don't have an opinion. I'm just wondering.
I went out to dinner with the missus before we were married.
Yeah.
nice little restaurant, and they had these martinis with stuffed olives.
Yes.
I think it was like blue cheese.
Yes. And you like that.
I was like, this is good. And I had them dirty.
But you didn't know whether it was stirred or shaken.
I had no idea. Didn't care. I just wanted more stuffed olives.
Actually, that's bringing back a memory because I was at dinner. This was like 10 years ago with the family, and Rob got it was 5 years ago. I don't know how old it is. Anyway, recently, and he got one of those, and he said, "This is pretty good." So I tried it. It was decent.
Yeah. And so, I had a few of them.
You did.
And then
I'm
banned. I'm banned for life.
That's what happened.
From stuffed olives.
From stuffed olive martinis.
Yeah.
So
You just keep drinking and eating.
Yeah, it was like, hey, these are pretty good.
Yeah.
And then they were going down pretty good, and it's like
yeah.
next thing you know, you got a little buzzed, and it's like,
and then it catches. Then it really catches up.
then
with
it
you.
catches up to you.
Yeah, got it.
Yeah, probably say stuff you don't want to say, and
And she married you anyway.
Yeah, you gotta apologize, and
Yeah.
Oh, good.
Hey, were you a poser?
I was a poser. I was posing. Yeah, I got a puppy. Terrible mistake.
What's yours? What
Call-
kind?
I don't.
You don't
It's
know.
little.
It's a mutt.
Little dog.
It's a small one.
Call it Bogey.
We have a dog, Cavalier Poodle,
Oh,
named Buddy, who's
Well-
close to a year and a half.
look at this.
That's apparently a bougie dog.
That's a bougie dog. She's got a cabochon and a cavapoo. Is that right? Cabochon?
I believe so. Yeah.
Sounds good.
Totally made that up. My hubby doesn't drink, but I enjoy a glass of wine, a Corona Light, and an IPA all at the same time. No, I'm kidding. That's what I was thinking.
Once or twice a week.
That's-
You projected yourself in
Yeah,
this. Let's see.
I just totally put
Have a-
myself in this.
Have a glass of wine with rose, and I have some Corona Lights, and then
Little-
except you don't have IPAs.
And a bougie dog.
I got a glass of wine, little sidekicker of Corona Light, and then an IPA just to top it off. I got 3 glasses all right there.
I just sip one after another. I'm not sure which is better.
That's perfect. But she only does that once or twice a week.
Yeah, okay.
I have a surprise for you guys.
Oh boy.
Really?
Yeah. Take a listen to this.
Here we go. It's time for the show. Joe and Big Al, we're ready to go. Oh yeah. Talking about your money, talking about your wealth, helping you retire in good health. Oh yeah. Let your money groove on. Don't you wait around. Joe, Big Al, and Andy, ready to move us down. Gonna break it down, give you the lowdown. Your money, your wealth, it's the hottest show in town. Let's get funky, let's get groovy. It's time to get down.
Wow. Who's this? Something pretty special here.
It's pretty good.
Yo, let me tell you about this little plan to secure your future. Yeah, that's a man. Retirement, investments, taxes on mine will have you saving the dough, reaching for the sky. They know it all, my friend. Money question to give you a hand. Tax planning, social security, Roth conversions too. Your money, your wealth.com. That's where you go to. Dollars and cents, making
Great.
money fun. Watch your wealth grow. Yeah, we run the run. So if you want to live your best life, financially free, check out your money, wealth.com. They'll show you the key.
So there you go.
Wow.
Wow. Is that one of our listeners?
Tell me more.
No, believe it or not, that is actually AI.
Oh,
There's an app called Suno AI.
Really?
And all you do is you give it a prompt and tell it what you want, and it spits out a song for you. So I put in that I wanted an upbeat, retro, funky theme song for Your Money, Your Wealth, a retirement podcast with hosts Joe Anderson, CFP, Big Al Clopine, CPA, and producer Andy Last. And that's what it gave me.
oh my. We
I think
have
that was pretty banging.
it's
Oh, banging. Yeah.
it's amazing, and it means in a few years we're all out of jobs. AI's going to do our show.
Wow. That was like, it brought me back to my high school days.
Right?
It's it reminded me of like a little Color Me Bad.
Right, exactly. Yeah.
Remember? Yeah, so a funny story, not really a funny story, but I had a doctor's appointment, the annual physical.
That was today.
Yeah,
Okay.
you get blood,
Sure.
you get your vitals,
Yeah.
all the good stuff.
Right.
You know, when you get in your 40s, you get all the good stuff.
Sure.
And so I'm giving Blood this guy. He's like, "Oh, Mr. Anderson, you're next." And he's like, "Oh, Mr. Anderson." He's like, "Oh, is that the
Matrix.
first, yeah, is that the
Yes.
first time you heard that?" I was like, "Yeah, first time, brother."
Yeah, what's that movie?
And then he starts going bananas on me. He's like, pricking me, and he's taking my blood. And he's like, "Yeah, you know what? My favorite movie was like Short Circuit." I'm like, "Short Circuit?" He goes, "Yeah, 1 and 2." And like, he was bringing up Gremlins. He was like,
Oh,
bringing
wow.
up all these movies that were like, oh my God. He goes, "You know what? You know what? They don't make movies anymore? Like Sister Act." He goes, "Sister Act. You know, they're coming out with Sister Act 3. And I was like, "I did not know that."
No.
Whoopi's coming back. He's like, "Yeah, I'm so excited because those were such well done movies."
I like the first one. I don't remember particularly caring for the second one.
Yeah. Sister Act. You big fan there, Andy?
Not really.
So,
So what does that have to do with our song?
it reminded me of like Calling Me Bad.
Oh, I see.
When
Okay,
you were in
got
high
it.
school.
Yeah.
And then, all these older movies that this guy was throwing out.
Got it.
Now everything is just bringing me back to,
Yeah, I thought
yeah.
it was funny that I put it upbeat, retro, funky, and it gave us basically Color Me Bad.
yeah. It gave you
I wouldn't call that retro, but I guess it is.
Oh, that is interesting stuff.
All right. Well, awesome. Thank you, Andy, for that.
And by the way, we are not sponsored by that AI company. I heard about it and I thought we need a theme song. Let's see what it comes up with.
Perfect.
How about that?
Yeah, I got goosebumps when the guy was rapping about me.
I bet you did.
Human musician friends, we know you can do far better. If you'd like to hear your original song about YMYW on the podcast, email me an MP3. Send it to andy.last@purefinancial.com. That's ANDI.LAST@purefinancial.com. And here's a tip. Joe's partial to the upbeat Motown style stuff that he can dance to. See you next week, friends.